अभी स्टार्ट मत करो, 2-4 मिनट के बाद
इनका सबका कॉफी हो जाएगा बाद में। लाइव आ रहे हैं।
अभी लाइट बंद करो, 1-2-4 मिनट के बाद।
It's already on.
Okay, people are able to see us.
Yeah.
How many people?
Good evening, friends. I welcome you all to this webcast on CARO 2020. This was originally a lecture meeting at IMC, but because of the government directives of restricting meetings, we have converted into this lecture meeting into a webcast. I compliment Chairman of the Accounting and Auditing Committee for having organized this meeting in a very timely manner. As you all are aware, CARO 2020, which was notified by government a fortnight ago, has undergone significant changes, and the responsibility of auditors is for the audit report which they would be issuing for the year ending 31st March 2020. I am reminded of our Articles Day when we were taught the auditors are watchdog and not bloodhound. But I think my personal belief, I may be wrong, the way the scope is being increased year after year, I think the auditors cannot be watchdog, and the scope of the auditors has gone much beyond that. With these opening remarks, I welcome Sudhir, Soni, a chartered accountant of great eminence, and thank you, Sudhir, for having made for this webcast. With this opening remark, I request Henil to give his opening remark.
Yeah, good evening, friends. As said by President, the CARO 2020 has cast tremendous responsibility in terms of various other aspects on statutory auditors. And with this short time, it will be really challenging. How do we, document our audit procedure, or how do we carry out our audit procedure, so as to, give justice to those questions which has been raised in the CARO. Now, friends, with a view to disseminate knowledge, we have actually organized this lecture meeting where our today's speaker is Mr. Sudhir Soni ji. Basically, he is a fellow member of Chartered Accountant of India with more than 30 years of experience. Presently, he is a national leader of assurance practice with SR Watley and affiliate network firms, and he serves as engagement partner for several listed Indian and multinational companies. Now, he is also a member of CII, National Committee of Financial Reporting, and also a co-opted member of the Accounting Standard Boards of Institute. Now, we could not find better person than him, basically delivering such a critical topic, lecture on the critical topic. I welcome him with a round of applause.
Thank you.
I herewith request our Vice President, Shri Anish Bhai, to hand over a memento as a mark of our love and affection to Sudhir Bhai. Please, sir. Friends, during the course of webcast, we also have a facility of you posting queries online. So I request all the participants to post their queries on the online portal chat menu, which is available while seeing this webinar. And we'll be compiling those queries, and will be at the end, towards the end of the session, sir will be delivering his talk. With this, I hand over the proceeding to Sudhir Bhai to take it forward. Sir, please.
Thank you. Thanks, Vibhul, Henil, Anish, and Arpita. Thank you for having me over here. The CARO order, as you can see, is a very topical issue. It was announced on 25th of February, and it's already applicable for audit reports that will be issued this year. And I would compliment the institute that they have responded equally fast to this development with the Ministry of Corporate Affairs issuing this, and we already have an exposure draft which has been issued of the guidance note, which will become for which comment period ends day after tomorrow. So that at a breakneck speed, the institute has come out with a guidance note on this topic. But I think we should look at CARO 2020 as not merely another compliance requirement. I think I would assume that most of the people who are listening to this webcast are practitioners and are auditors. And if we want to stay relevant going forward, then I think we have to implement this order in the right spirit. It significantly enhances what I would describe as the audit product. And I use those terms because as we speak, the UK is going through its own introspection of the whole audit, a gamut of topics around audit. And one of those themes is the audit product itself. And, we have historically been delivering an audit report, which comments on the true and fair view of financial statements. But as events have unfolded in the recent past, events around diversion of funds, major corporate frauds, significant non-compliance, auditors have been on the defensive to explain as to why their audits did not address these topics. And we cannot keep using the defense of an expectation gap, which is to say that the expectation of stakeholders is beyond what the auditors and the auditing standards are supposed to deliver. And if we need to stay relevant, we need to step up our audit to bridge that expectation gap. And I think that is what CARO 2020 does in a very big way. What is that expectation gap? The expectation gap is typically been around 2 or 3 topics. First is, what is the responsibility of the auditor towards fraud? And we say that if we come across fraud, we will look at it. If it's material to the financial statements, we'll look at it. But clearly, I think over there, in many audits have been found to be wanting. The second is on the solvency of an enterprise or its or the ability of a business model to survive. And very often again auditors have not been able to call those issues out, and I think this CARO makes a specific expectation towards that. And the other is on compliance of law. So I think many of these topics, and if I add one more on the expectation gap, that would be corporate governance issues. Have we as auditors called out corporate governance issues? And I think the CARO 2020, as I will explain later on through some of its requirements, will in fact ask us to address those corporate governance topics as well. That is why what I would urge is that if we want to stay relevant, this CARO 2020 gives us the opportunity to comply with this in the spirit, not merely in form, to raise the conversations that we are having purely from a compliance of accounting standards to topics which would be relevant to the boards, to audit committees, to CEOs and CFOs, which are topics around fraud, solvency, compliance with regulation, and business models. Also, this CARO will provide additional information to besides the investors. I think it's not targeted only to investors. It will provide information which is relevant to creditors, lenders, rating agencies, and also regulators. And that is why I feel that this will be a significant step forward in bridging this expectation gap. Let's take a quick overview of what the CARO is. If you look at it quantitatively, there are 28 new requirements, including the sub-clauses in CARO 2020, and 16 of the existing requirements have been modified, 7 have been carried forward. There were 50 topics. In terms of applicability, I haven't even spent time putting a slide on it because in my view, it's applicable to almost all entities. If you exclude banks, insurance companies, and NGOs, it applies almost to all the other companies. The eligibility thresholds are so low that they don't even merit a discussion. So for example, private companies with a capital of 1 crore or reserves of surplus of 1 crore or turnover less than 10 crores, those are the kind of companies which are exempted, which would be very few. I think the relevant population therefore is much wider. One thing is clear, that you will need to perform additional procedures to answer many of the topics that are in CARO. They go clearly beyond reporting on the true and fair view of financial statements and internal controls over financial reporting. So the topics are additional. It means there will be more efforts, and clearly you need to engage with your clients both in terms of the fact that you need additional information to be able to discharge your responsibilities, and also the fact that that there will be additional costs of performing the audit. So I think that is a quick overview. Let me deal with the issue of consolidated financial statements very quickly. There was an issue in the earlier CARO about whether it is applicable or not applicable, and there was a certain dispensation, but this CARO has simplified the issue as far as the audit report on the consolidated financial reporting is concerned. And that is dealt with in clause 321 of the CARO 2020 requirements. What that essentially states is that as far as the consolidated financial statements are concerned and the audit report on that is concerned, the CARO report is only that clause is applicable. And what that requires is if there is any qualification or adverse remark in the CARO of any of the subsidiaries or entities which are being consolidated, then that shall be presented by way of a reference to the paragraph number in that report. So first is visually, how will this report look? Visually, you will have a 1 para report on the consolidated, a 1 para CARO on the consolidated financial statements. Now, though the way the drafting is, it would suggest that you will only include the para numbers of reports of subsidiaries, JVs and associates. If you see the exposure draft, I think rightly so, it says that it would be incomplete if you did not refer to the parent company's standalone CARO report and include those paragraph numbers also. So essentially, in the CARO report for the CFS, you will present para numbers of the parent and all the entities which are being consolidated, which include a remark which is adverse or a qualification. Now that itself is a subject of discussion, that what is a qualification or adverse remark in the context of CARO reports. That is because many of the paragraphs there are factual. So for example, if there is a delay in the deposit of a provident fund due which is reported in under CARO, is it a qualification or is it an adverse remark? Now that is not clear, but if you use also the word unfavorable, and para 4 of the CARO report uses the word unfavorable in a similar context. So the institute has again in the exposure draft interpreted all these terms as interchangeable: an unfavorable remark, a qualification or an adverse remark. A qualification, what is discussed in SA 705 is not relevant for CARO. It doesn't fit that. That is in the context of the true and fair view of financial statements. So basically, when you're referring to paragraph numbers here, you will refer to any remark which is perceived to be unfavorable. And as I said, some of these may be factual statements. For example, there is a default in payment of a repayment of a loan. You are going to be reporting that in CARO. In my view, that's unfavorable, and therefore that will need to be referred through this para reference in the consolidated financial statements report. As I mentioned earlier, the institute's guidance note is exposure draft of the guidance note is out, which are closed for comments in the next couple of days. But what I have done through the rest of this presentation is I will be discussing the concepts based on this present exposure draft, and it is open for comment. And I'll also let you know where some of the areas I feel that maybe that exposure draft may need some revision as well. I'm also focusing more only on the changes and the new requirements, and not as much on the requirements which have no modifications which are there. Coming to one of the most important changes that have been made by CARO 2020 is to require that in case a company has a working capital limit sanction from banks in excess of or financial institutions in excess of 5 crore rupees on the basis of security of current assets, whether their quarterly returns are in agreement with the books of account. This is clearly an effort to bridge the frauds that are being done on banks or on lenders by sending them returns of security which are in excess of what might really be available with the corporate. And in my view, this clause will be read very carefully by banks going forward, because it will give them ready access to at least a certain level of comfort that the statements they receive are in accordance with the books. The important facts, points to consider here are they have emphasized on quarterly returns. We don't know whether the banks or financial institutions ask for quarterly or monthly returns. It might even be monthly, but the fact is they are the CARO is only asking to confirm on the quarterly returns. The second is that they are only asking for this where the working capital is given on the basis of security of current assets. So if you have got working capital limits based on other than current assets, then this clause is not applicable. That's again, where I say that you must look at things in spirit and not in form. Is that the intent? A strict legal interpretation would restrict you to do that, but otherwise, I think if companies are filing quarterly returns, even if you have borrowed on the basis of fixed assets or others, the intent is that the statements that you're filing quarterly, are they in agreement with the books of account? Now, the issue that is not dealt with in the exposure draft here is the fact that other than listed companies will not be preparing quarterly books of accounts or closing their books of account every quarter in a very thorough manner, if at all they close their books of account every quarter. And in my view, the exposure draft should deal with this, and I would have proposed that the audit report should caveat that it is in agreement with the unaudited books of account. This is because it would be very simple to book, certain journal entries to bring the level of current assets in your books to a level of what you are going to want to report to the bank. And if it is not subjected to an audit or a review, then that would be something where, as auditors, we would run the risk of confirming that compliance. I now move to what I believe is the most significant change in CARO 2020, and this is to bring a level of focus on the investing activities of an enterprise. I just want to emphasize firstly 2 or 3 aspects of the reporting requirements itself. First is they emphasize the word during the year, so it's not only at the end of the year. Because we have seen malpractices very often where companies would have a loan outstanding throughout the year, and at the end of the year you square it off and it's born again in the first month of the next year. So the reporting under this is for the whole year and not only at a point of time. The second is that the types of transactions which are covered by this as compared to its earlier CARO 2016, they have extended the type of the activities to include investments, guarantees, and advances in the nature of the loan. The earlier 2016 CARO only required loans to be covered, and the other most important aspect is that in 2016 it covered only related parties. This whole emphasis of investing activities and the questions around that was focused on related parties, whereas now it is all. And I think this is because of a realization that corporates have often used, companies are smart to structure transactions in a manner that if you have a restriction on related parties, then you route it to other companies and through them to related parties. So now the comments of the auditors in this clause are across all, are for all parties and for all loans that are given. So this is one important aspect. The second important aspect is the use of the word advances in nature of loans, and it's not new. This terminology is not new for us. We've had this in the past also in the law and in CARO requirements earlier. And typically the guidance, this I've taken from the exposure draft, and I think that's fine, which is to say that an advance which exceeds the operating cycle would normally be an advance in the nature of loan. And another test could be if an advance, for goods is interest bearing. It's not necessary or determinative that is an advance in nature loan, but it is indicative of that fact. So that is, I think, the requirement. If we look at some of the sub clauses over here, now very interesting that 2 of the clauses in this set of is this 3, it's clause 3 subsection 3, 2 are exempting what I would call NBFCs. It says not applicable to companies whose principal business is to give loans, but the other clauses are even applicable to NBFCs. So they apply to all companies, but even to NBFCs. And the reason I emphasize that is that I can understand for a manufacturing company the level of attention you need to these topics, because these are transactions which are in the nature of investing activities. But when you look at an NBFC, we are talking of their operating activities. And let me come to this requirement under 3B. 3B says, and this in my view is probably going to be one of the most difficult clauses for auditors to address. It says whether the investments made, guarantees provided, security given, and the terms and conditions of the grant of all loans and advances in the nature of loans and guarantees are not prejudicial to the company's interest. It means the auditor needs to make a judgment. Firstly, also remember the requirement here, unlike the earlier one, is not merely on the terms and conditions. It is not asking whether only the terms and conditions are prejudicial. That one is relatively easy because you may have an interest rate and you can benchmark an interest rate, and you may look at terms of repayment and have some benchmark on the terms of repayment. But in my view, it is also asking you whether the transaction itself is prejudicial to the interest. So whether your investment or the guarantee given is prejudicial to the company's interest. And to that extent, you are stepping into the domain of what's the propriety of the transaction, and which is what I said, that it significantly raises the level of obligation that an auditor has. Now, one may try to rationalize to say that if a company has followed appropriate approval processes, then this is easy to answer. So if it's a loan covered by section 186 and I have followed 186, then I will therefore be able to say it's not prejudicial, which eventually says if the approving authority is the board of directors and they've approved it, then I'm fine. In my view, that defense may not always hold true. Now, what can be examples of loans which are prejudicial to the interest of the company? And I'll give you an example of transactions I've seen. So you will see a transaction where, let's say, you were talking of a large company which has good cash flows, and they give a loan to, let's say, a private limited company as an intercorporate deposit, 100 crore rupees. And you look at the accounts of that private limited company and you believe that that company has no business, or it really doesn't seem to justify. And the company says, hey, this is my decision because I'm lending to that company. But I think you are on inquiry to understand what is the purpose of the loan that you are giving. And I won't be surprised if you find through a chain of transactions that eventually that money reaches a related party. So what may happen is that if you're giving loans where the business rationale or the commercial rationale is not apparent, I think, and also we all know that with technology being available today, it's very easy to check these trail of transactions, or at least know about the company. So if I've given to X Private Limited, it takes me half an hour to check it, get all the download from the website on who is X Limited, who are the shareholders of X Limited. Can they take 100 crore loan? What would they do with that? So I think this is something which probably auditors will need to look at more closely in terms of where companies are investing their funds. Then the next question, of course, and I think this was there in the past, I think the most important point, and I will do this at the cost of repetition, is that we are now talking of all loans. We are not restricting this to related parties, where your emphasis earlier was on related parties, and which is why I feel that this is really challenging for an NBFC, because almost you could virtually question any single transaction that they do. And having said that, we know that materiality is a concept and it will apply in Caro, and the exposure draft reiterates that, which was also there in the earlier Caro, that materiality is overriding. But let me tell you that materiality applies to each clause. So you cannot apply materiality at a financial statement caption level. If I'm commenting on investing activities on loans given, then I'll apply materiality there. And you also consider qualitative factors when you determine materiality. So I think one needs to be careful about that. So in my view, this decision of whether all these financial transactions are prejudicial or not. So for example, I am a, let's say, company in the cement business, and I have made an investment in a media company. Will I as an auditor say it's prejudicial, and it's gone through the board process? So I think we are going to have some difficult conversations to have over here, and at least we probably get into that domain that is there. The next set of questions on investing activities is on overdue, which is factual, so I'm not spending time on that. The 3E is interesting. What this basically is trying to ask, and here it doesn't apply to NBFCs, which in my view would have been probably one of the would have been logical to apply to them, but nevertheless, this tries to address the issue of evergreening, which has been in focus recently. And you know what evergreening is. Essentially, you're saying you're given a loan to an enterprise. The enterprise on the due date is unable to pay you back. And so you assist them in paying back that and create a fresh loan to them. It can be done in different ways. You can renew the facility, or you give another loan to them. But life is not so simple. You don't evergreen by just giving another loan to the same enterprise. Typically, evergreening is done through a more complex structure of transactions. This clause does not acknowledge that. Here, the question is simply limited to whether to the same party you have given another loan. And I think to that extent, it is factual reporting. But the issue in their mind is obviously to see that has there been an evergreening of a loan. The next clause, and this is the last of the investing activities, is whether the company has granted loans repayable on demand. Now, this is one of the easiest ways companies would ensure that you don't have defaults, is you give loans repayable on demand and say, but look, so you give loans to a weak enterprise. Let's say I'm a strong corporate enterprise and I have a group company which is where the business is struggling, and I give them a loan which is repayable on demand. Because if the auditor asks, he says, but हमने demand नहीं किया है, so then for the loan is current, so you're not really worried about it. And I think the Caro has rightly called this out, because you did not have an opportunity to report in Caro because there was no default. They said, look, we have not called and therefore it's not due. And so what do you want to report as an auditor? So what Caro 2020 now asks, and they are therefore addressing such structuring issues, they're actually saying factually, if you have given loans where there is no stipulation for repayment or which are repayable on demand, please give the numbers. And within those numbers, also distinguish those which are given to related parties. So I think this is good. It addresses some of the structuring issues companies would have done. And the worst part of this sort of a structure is that if you have it repayable on demand, companies may well argue it's a current asset when you know that it's never going to come, or probably not in the near future at least. So to that extent, I think this is a good requirement that has been brought into Caro 2020. The next important change is in the clause which relates to compliance with fixed deposit regulations, and the change that has been done is to add the words amounts which are deemed to be deposits. Now, very strictly speaking, this was not necessary, and even without this, you would have assumed that deposits would include those amounts which are deemed to be deposits under the law. Having said that, I think Caro 2020 is trying to plug all the loopholes which are being used in the system. And this is of course on the receipt side. So here we are talking about companies which have taken money, which is actually in the nature of deposit, but it is camouflaged as something else. And some of the examples of what could be such deemed deposits are advances for supply of goods or services. If there are advances taken for supply of goods or services and those are not settled within 365 days, then they are deemed to be deposits. And there are such other transactions, advances in consideration with sale of immovable property, or an advance for a long-term project for supply of capital goods. And what the rules say, that if these become refundable because the necessary transaction is not being consummated, then within a period of 15 days from that date of when it is due for refund, it shall become a deposit. It shall be deemed to be a deposit. And then consequently all the provisions of section 73 and section 76 become applicable. Of course, as you're aware that this section will not apply to companies which are registered with the Reserve Bank of India or the NHB, because those are deposit taking entities. This is more for other companies which are there. And then the rules will be around returns that are to be filed and things of that sort, and the limits for fixed deposits that are there. Yeah. The next is a very interesting change in Caro 2020, and this is a question, and I think since I was the Chamber of Tax Consultants, maybe you'll be in a better position to appreciate this requirement, but let me call this out first. So this is whether any transactions not recorded in books have been surrendered or disclosed, and the emphasis is on the word surrendered or disclosed as income during the year. So the scenario you can anticipate is pursuant to a search or seizure operation, an assessee is making a disclosure and is offering certain. I have been faced with this situation a few times, and I'm glad it's just a very few times in my career, and it raises a lot of questions when you have such a transaction. It raises questions on corporate governance, and it raises questions on internal controls over financial reporting, which are incidental to this. But if I look at the clause I've just described, and the exposure draft has given a few guidance on this. One is that if the statement which is made pursuant to a search and seizure has been retracted, then this clause would not apply. And I believe that at times that is also part of the strategy. And also, if the SSC has disputed the additions, then those are not to be considered. With those exceptions, you would need to report over here that whether these transactions have been properly recorded in the books of account. Over here. Would you like to comment on this aspect? Okay. Now we come to the next set of activities, which I think the CARO has made again a very significant change, and this is the opposite of the scope of this reporting has been extended to all lenders. Where earlier this emphasis used to be typically on banks and financial institutions, and now it's been extended to all the lenders. So even if you have intercorporate deposits, private loans, or loans from group companies, then those are also covered within the scope of the reporting under this clause. They have provided a format to report the default of loans, and in the format what has been clarified is that the reporting shall be only for banks, financial institutions and government. So similar details as in that format need not be given lender wise for other lenders. So you need to give it by each bank, financial institution and government, but you need not give it for other lenders. And also you need to give, the way the format is drafted, you would also need to give details of defaults which have happened during the year. So it is not sufficient that the default has been settled by at the end of the year. Even if it is during the course of the year, that needs to be, if the application has not been approved, then you're in the situation of default. So merely making an application does not relieve you from the responsibility of reporting a default. If the application has been approved for rescheduling or restructuring, then the auditor is advised to make a disclosure of that fact in the loan. Now this is important because many companies would completely like to avoid any reporting under this, but the exposure draft, the way it stands, would not allow that. Even if subsequently this has been approved, it would actually require to make a disclosure of the fact that this has been subsequently approved. The next requirement in the financing activities is whether the company is declared a willful defaulter. And here I would like to emphasize on this word, besides bank or other lender. The question is whether company is declared willful defaulter by any bank or financial institution or other lender. Now the Reserve Bank has a very transparent mechanism for identification of willful defaulters, and these lists are available on the website of the Reserve Bank. Also CIBIL provides the list of those of the willful defaulters and all which are there. So CIBIL and CRIF, Equifax, number of agencies do provide this information, and so auditors would be advised to search for their auditee client whether they are in any of those lists. And you know that willful defaulter is declared when there are several scenarios which Reserve Bank defines for a willful default. Example of few of them are where entity has the ability to pay a loan but is not repaying that loan, or they have diverted the funds for a purpose which was not, for which it was not sanctioned, or the security has been alienated, what has been provided to the bank or institution illegally. So there are such scenarios by which a company is declared as a willful defaulter. So the question that the big question here is that can another lender declare you as a willful defaulter? And so, for example, if I was a private party and I gave a loan to company X, and I would say, company X, you're not paying me on time, and I want this interest rate and that interest rate, and so I can actually create difficulty for them by saying I'm declaring you a willful defaulter, because to me the Reserve Bank mechanism doesn't apply. So the exposure draft has addressed this topic by saying that when we are reporting on willful defaulters, it should typically be only by the bank, financial institution or government, and not for other lenders, which seems to be, as I said, an issue of interpretation. And it's probably just, but because you need a degree of balance before someone can be declared willful defaulter. If someone is unilaterally given that right, then it could be abused. So the exposure draft has given that guidance. The next question in the financing activity side is on whether funds raised on short-term basis have been utilized for long-term purposes. Now, many of you will recollect that this is not new. This used to be there in the CARO earlier, and then it was dropped and it has been brought back. So this is another effort to see how companies are managing their funds, and what you would call an asset, is there an asset liability mismatch that is arising. So I again won't spend too much time on this topic, because the determination of this is like we were doing in the past. So if you take your balance sheet and split it into 4 parts, into long-term funds and short-term funds and long-term application and short-term application, and if you find that long-term funds are significantly less than long-term application, it would mean that the short-term funds have been financed, that short-term funds have been used to finance long-term assets, and which would reflect that there might be liquidity pressures that is there. And this is not the only place that the CARO 2020 is focusing on an asset liability mismatch. I will come to the other one later. So this is one. The next question is not as easy to answer. This question is if whether the company has taken any funds from any entity or person on account of or to meet obligations of its subsidiaries, associates or joint ventures. As I mentioned at the beginning, that there is a lot of emphasis on diversion of funds and how funds have been moved around by companies because of the number of corporate episodes that we have seen in corporate India. Now, the reason this is challenging is that it may not always be apparent that funds have been taken for the purpose of deployment. So, as an auditor, you would ask for a schedule of funds invested in the subsidiary, associate or joint venture, and then try to determine as to what was the source of that funding. And sometimes it will not be one-to-one. So this might mean an element of judgment, in seeing how those cash flows have moved, to see have you borrowed from some entity to invest in these subsidiaries, associates or joint ventures. The next question is again factual. So that is where companies have raised loans on pledge, and the details for that need to be provided.
Logins.
Okay.
Busse.
Yeah.
200 logins. So that's what I'm saying. So the speaker has made the difference. Okay, for some more coffee?
No, I'm good. Thank you. Thanks. I now come to fraud. I think, in my view, amongst the, if I were to put the top 3 topics that CARO 2020 addresses, I think the first was on the investing activities. The second is fraud, and the third is on solvency, which we will come to a bit later. But it has brought significant attention to the topic of fraud. The first topic around fraud that the company, that the auditor needs to report is whether any fraud on or by the company has been noticed. And this reporting has been enhanced from the earlier reporting, where the word officers or it was restricted to frauds by officers or employees. So now any fraud, whether it is a third party or a vendor fraud which is there on the company, even that would need to be reported under this clause. Our reporting under this clause is fairly mature, so I'm not going to spend too much time on this. All that this amendment has done is expanded the scope of the frauds that need to be reported. But we have all the experience of reporting under this, and to remind you, materiality is a concept which is always applied. So I think one has to keep that in mind, particularly when you're reporting under this clause. The next one is interesting, and this is asking a question of whether any report under subsection 12 of section 143 of Companies Act has been filed by the auditor in form ADT 4 as prescribed under Rule 13. Again, put an emphasis, has been filed by auditors in form ADT 4. The reason I put this emphasis is that you as auditors, we are all familiar with the process of section 143.12, which is set out in the rules. So if an auditor has a reason to believe that there has been a fraud, then within 2 days the auditor needs to write to the board of directors of the company and has to ask the board of directors of the company to investigate whether there is merit in the auditor's reason to believe, or whether the belief of fraud is true or not. And the board of directors are expected to reply, the company is expected to reply to the auditor within 45 days, and the auditor has to file ADT4 within 15 days after that 45 days. So if you see this process, it's a 2-month process. The issue arises when you are at the year end and you have noted such an observation, and under section 143 written to the board of directors, but the time period for them has not elapsed and you have to sign the Caro report in between that. A strict reading of this clause will mean that that is not covered. So though the auditor has written a letter under section 143.12, because the time period for the board to investigate is not complete, the auditor has not yet filed ADT4, therefore this reporting is not triggered. That would be a very strict interpretation of this clause, and probably rightly so, because at that point of time an investigation is still in progress. The other aspect of this question is that it's not clear as to what is to be reported. Do you merely want a factual reporting? Yes, I confirm as auditor that a form in ADT4 has been filed. From the question, it would appear as if that is sufficient. And I think, I don't know whether it will help in any perspective, but that's how it currently seems to be. And the exposure draft has not given any guidance on what details should be provided in case an ADT4 has been filed. It's a very sensitive topic. My sense is that at some time, matters which are reported under 11B in a yes or no will progress into clause 11A as frauds by or on the company if and when that is determined. And so maybe that is the place where that will get parked. And so merely a factual reporting here should be fine. And the reason I say these are sensitive is because, as I said, at the first place it's only a reason to believe. In the second place, maybe an investigation is still in progress. More aspects of fraud have to be considered before that determination is made. And there is anyway a reporting requirement under clause 11A for when a fraud by the company or on the company has been noticed or reported. And so therefore it's not as if you will escape that reporting, but in my experience in these matters, timing is of great essence as to when and how and what you should report. And therefore I think to me that is possibly one of the factors to consider in the second thing. The other very important change in fraud is whether the auditor has considered whistleblower complaints. I think this is a very important step. In my experience, auditors do make those inquiries even today, and to that extent it is not new, but this is actually empowering an auditor more to seek full details of all the whistleblower complaints, and it makes it obligatory on companies to share that with the auditor. The important issue is what is this consideration supposed to mean, and how is it? How does this change anything from the past? So, as I said, to some extent, by making an auditor very specifically assert that you have considered whistleblower complaints, you are elevating the importance of this activity and this conversation that the auditor and the auditee need to have. Does this impose the necessity for a company to have a whistleblower mechanism? The answer to that is no. The Companies Act prescribes under section 177 those companies which need to have a vigil mechanism. That's not necessarily the same as a whistleblower mechanism, but that's what the Companies Act prescribes. And Regulation 4 of the SEBI requirements or listing regulations also requires listed companies to have an effective whistleblower mechanism. It is therefore this clause will not have the effect of making whistleblower mechanism mandatory for other companies, But what it would require is that if other companies do become aware of whistleblowers, and whistleblower is not necessarily a very structured mechanism, so we would seek representations even from companies who don't have whistleblower mechanism. Have you received anything which would be in the nature of a whistleblowing complaint that is there, or a blowing event which has happened in the context of your company? So that is one thing. What would be the auditor's considerations? Typically, as auditors, there are two types of frauds that really are relevant to you, both under SA 240 and under the auditing, that's under SA 240 of the auditing standards. One are frauds which are fraudulent financial reporting, or topics of fraudulent financial reporting. So for example, in a recent case, there was a whistleblowing that the revenue recognition followed by the company was not appropriate. So that's an example of a whistleblowing on fraudulent financial reporting. Or it is a misstatement resulting from misappropriation of assets. So for example, if funds of the company have been diverted to third parties or to related parties through a mechanism, and a whistleblower brings that to your attention. So those are examples. So two things. First is fraudulent financial reporting, and second is misappropriation of assets. These are the two topics which are really relevant for an auditor. Because under whistleblower, you may receive a range of complaints, and therefore the auditor's attention does not have to be diverted to all of them. I would, however, state that depending on the nature of the whistleblowing complaint, at times you may need to evaluate some other aspects. So for example, if there is a whistleblowing complaint which questions the integrity of a key managerial person, then can you rely on the representations of that KMP? Those would be questions you would need to ask. So therefore, as an auditor, you would need to see how that whistleblowing is dealt with. Has a proper investigation been done? Because otherwise you are left with a certain grayness on the reliability of or rather an open topic. That is why this is also a bit of a difficult clause, because you may often have whistleblower complaints very close to your signing off of the audit report, and what do you do in that circumstance, and you're not sure whether it's right or not. So I feel that this will often create practical challenges for companies, and it will probably, we'll have to see how the practice evolves further around that, and to what extent auditors should, once you have a whistleblower which is very close, how would you need to respond to that? What are the nature of disclosures that can be made? And we have a few examples recently where auditors have drawn attention to the fact that a whistleblower complaint has been received, and that they're not qualifying the opinion for that, but the fact that readers of financial statements should be aware that such a complaint has been received and that needs to be investigated. So maybe that is the approach that auditors may need to take depending on the severity of the matter which is there. Yeah. The next topic which is new is on internal audit, on whether the company has an internal audit system and whether the reports of the internal auditors were considered. The first one is again something we have been familiar with in the past. We used to opine on this earlier, that whether a company has an internal audit system which is commensurate. But this question has been reintroduced into CARO 2020, and the guidance note is that the exposure draft of the guidance note suggests that an auditor needs to comment on the on this aspect, irrespective of whether there is a statutory requirement under section 138 for a company to have an internal audit or not. So that is a guidance which is coming from there, and I would agree with that, because the way the CARO is drafted doesn't ask whether the company is required and has maintained. It simply asks whether the company has an internal audit system, and so that is the guidance that is there. In terms of what the auditors need to consider the internal audit reports for, it could be various topics, whether there are findings of the internal auditor which have a financial impact on the company, illustrations of either misappropriation of assets, shortages in physical verification of inventories or fixed assets, or compliance topics that might be brought out, or contingencies that might be brought out. So that might be another topic that from the internal audit reports auditors can pick up. Clearly, internal control over financial reporting is another aspect. And the auditors can also consider the extent of audit procedures that need to be performed. And there is a guidance, I think there is a auditing standard on SS 610, I think, which is on how you leverage on work of internal audit in the context of the auditor. But this requirement is for the auditor to make a positive assertion that they have considered the reports of the internal auditors when they are signing off the opinion. The next important topic, and this again I mentioned earlier, is that the CARO focuses on compliance with laws and regulations. So one of the questions in this set of these set deal with whether companies are performing activities which need to be registered with the Reserve Bank of India. Clearly, there have been cases where it has been determined that companies have been either lending or borrowing or investing, and they have not followed Reserve Bank rules or not registered with the Reserve Bank, and therefore have not been subject to appropriate supervision. The first aspect of this is whether company is required to be registered under Section 45(1)(a), and I think this was already there in the CARO earlier, and therefore most of the focus in the past was on what is called so-called the 50-50 test, which is to say that if a company's principal business if the financial activity as principal business is when a company's financial assets constitute more than 50% of the total assets and income from financial assets constitute more than 50% of the gross income. If you satisfy both these criteria, then a company will be regarded as an NBFC by the Reserve Bank, and a company needs to be registered. So historically, the emphasis has been a lot on this aspect of the rules, and this guidance, which is issued by the Reserve Bank many years ago, is what is used as a test of what is the principal activity. What has been added over here is one is the housing finance activities being conducted without a certificate of registration. So that's a specific question that is being asked. And the next one is on whether the company is a core investment company, and whether they have been are they registered or unregistered. Because if you are a CIC and you are systemically important, then you are required to register. Other entities are not required to register. And you're familiar with the rules around this, that a CIC would be a company which has more than 90% of its assets is in the is in equity, preference shares, bonds, debentures, or loans in group companies, and not less than 60% of that is in equity. They do not trade in investments of group companies and do not carry on any other financial activity referred to in sections 45I and 45I. And it is systemically important if the asset size is 100 crores and or so that would mean that they would need to register in that scenario with the Reserve Bank. And the last question in that is a factual question of whether the group has more than one CIC as part of the group, so that would need to be reported on as well. Yeah, I now come to the last of the major clauses that I wanted to discuss, and in my view, this is the most significant of the changes that CARO 2020 has done, and it probably puts the auditor in the most difficult position. What the auditor is expected to report under this clause, and they have set out a set of information that the auditor may use to enable them to report on this. Is debatable whether this is exclusive, but that's how the exposure draft seems to have interpreted that. It's only based on these 5 topics, which is financial ratios, expected aging of assets and liabilities, other information, auditor's knowledge of the board and management plans. The auditor needs to confirm that no material uncertainty exists as on the date of the audit report. So let me emphasize here, as on the date of the audit report, as distinguished from the date of the balance sheet, which means that you need to consider events right up to the date of the audit report in making this determination. Next is that the company is capable of meeting its liabilities existing at the date of balance sheet, as and when they fall due. And now I would like to emphasize on the words as and when they fall due within a period of 1 year. In my view, this is a very onerous requirement. So we are not merely asking the question that is the company a going concern, because when you read this, your intuitively response is, okay, if I am a going concern, then I'm able to, I will be able to give a clean report under this clause. That may not be the case. Let me give you an example. So you are a going concern because you have sufficient assets and you have a guarantee from your parent company to say that in case you have an issue, then I will take care of you and see that your operations survive. But at a company level, the question is as granular as saying 5 months down the line, I have a loan repayment of 100 crore rupees which is falling due. Do I have the ability to pay 100 crores 3 months down the line? And are you making any assumptions in making that determination that will you be able to pay the 100 crores at that point of time? Because if you are not, then you will be in this clause. You should have had a qualification to say that you believe that the company may not have the sources. Now, in practice, very often I found expectations of companies beyond, of course, business plans is on refinancing. Where you have loan obligations payable during the course of the year, and you say, yes, I will be able to repay this because I'm going to refinance my debt. I'm going to raise fresh source of funds. And for many companies, this is almost a business model, which is that you're able to refinance your debt and pay your liabilities or liabilities which are coming up, even though you don't have sources from your current operations to generate that sort of cash. Now, therefore, you're making an assumption that you will be able to refinance. Or if the management tells you, I have a plan to raise equity 3 months down the line, and therefore I will be able to meet, because you can consider management plans, what this clause allows you to do that. In my view, this will be very judgmental. First is, what is the information you need? So the information you need from the company is you need a projected set of payments during the next year. It's easy on the liability side, but it's difficult on the asset side to say that your realizations will follow a certain pattern, because your liabilities you can probably be more certain about based on contractual obligations or otherwise. And also then you may have situations like, of course, this says liabilities existing at the balance sheet date, but there might be contingent liabilities as well. And if we take our famous case, which I think currently is in the newspapers, then the question is that would someone have anticipated that that liability was there at the balance sheet date? How will an auditor anticipate what will be those liabilities? And if you're not able to meet that liability because it determined during the current next year, though it was a contingent liability, then what is your obligation? So I think it's a very complex topic. It's not merely about going concern. It is a question on a company's ability to manage its liquidity in a manner that it will be able to satisfy the liabilities as and when they fall due. What I expect, because of this specific reporting requirement accounts, and there are more of those in public domain, because an auditor may be very uncomfortable to give a very clean, particularly in stress situations. If it's a very clear situation, you're sitting over a bank balance of 1,000 crores, then probably you're not worried about it. But if you have a stress situation and you are going to be making this assertion, or for companies which are leveraged, it may not be very easy to make this determination. And I can see that there will be a lot of conversations on this topic. That is there. So I think those were some of the most significant of the changes that are there in the CARO 2020. Let's look at some of the other clauses which I have not discussed in so much detail so far. One of the amendments which has been made to our clause, which has probably been there in CARO from day one, is around fixed assets. And the question that was historically being asked is whether a company has proper records of its fixed assets, have those been physically verified, and have the discrepancies been dealt with. I think the good part is that they have introduced and recognized the importance that today increasingly a lot of valuations of companies are being driven by intangibles, and tangible assets don't necessarily form the major part of that of driving a company. And so there is a clause which has been introduced to say whether companies maintaining proper records showing full particulars of intangible assets. Now here I've read the exposure draft, and I maybe stand to be corrected. I'll read probably again a few times. I'm not very certain whether we are only talking. I mean, the exposure draft does take you to the accounting standard on intangible assets and talks about intangible assets which are on your balance sheet. But you know that a company has a lot of intangible assets which are self-generated, which may not really be on your balance sheet. And when the way this question is worded, even those might be there. So, for example, if you have a valuable IP which you created and you have not recorded that as your asset because of the accounting rules, because it's self-generated, would you include that also, or would this be like the fixed assets where you tally or comment with the book amount that is there on the books? So I think that is one aspect which we need to probably explore further. I think it is alluded to in the exposure draft in some way, but I think we need to read that bit more carefully. So is it intangible assets which are on the books, or also intangible assets which are off the books? The second comment I have over here is if you're looking at intangible assets on the books, and remember that all the reporting requirements except for the first one which I mentioned apply to the standalone financial statements. So what you will see if you study corporate balance sheets is that the value of intangible assets on the consolidated financial statements is significantly higher than even if you aggregate the standalone financial statements. And that is the reason is that a lot of intangible assets get recognized when you do business combination accounting. So the fact is that though CARO 2020 had a good objective of trying to get the auditor to report on proper records of intangible assets, some intangible assets which are in between the consolidated and the standalone will not feature and will not be reported on at all, which is in my view going to be far more significant than what's on the balance sheet today in the standalone. So I would have actually felt that this clause would have been better applied to the consolidated financial statements, but that's a separate point of view. I think it's very clear now these do apply to the standalone financial statements, and there is a description on what a proper record consists. And it's good probably that this level of focus has been brought on from the past. It was the next question which has been introduced in CARO is on resignation of statutory auditors. It's been a very popular topic with all regulators in the last few years, with a number of auditors resigning. And the question that has been asked is whether the auditor has taken into consideration the issues or objections raised by the outgoing auditors that is there. Again, I feel that this is probably putting it out on the auditor to answer. In my experience, any auditor would address this. Any auditor who's coming in and has topics which have been raised. The important issue as always has been whether the outgoing auditor has spelled out the right reasons and the full description of the reasons for resignation, which now the regulation requires. I think once that is in place, then it would be naturally incumbent on any auditor to have considered that. But this statement requires a positive assertion that the auditor has considered this. And then there are two clauses which have been inserted around corporate social responsibility, CSR obligations sections, and they are requiring the auditor to comment on the compliance with section 135, 5 and 6, which is on how you deal with unspent amounts. The interesting part is that both these sections are not yet notified by the government, and therefore they are not yet operational. And I don't know whether this is a hint of what is going to come or whether this is likely to happen in the near future. But if it doesn't get notified, then I guess the reporting, and this is what also the exposure draft mentions, the reporting at this year end will be to say that this clause is not applicable or is not yet applicable. Lastly, coming to the updates to the existing clauses, some of the important updates to the existing clauses. I think the first one is just semantics. The second one is on inventory, and here they have now defined a level of discrepancy which was not there earlier. Earlier the question was whether discrepancies was material. Now they have quantified that at 10% for each class of inventory. So that has been prescribed. On the statutory dues, GST has been added, which I would see as only an update. And in respect of disputed dues, now all statutory dues are covered. Earlier there was a prescription on which statutory dues were considered, and as I said, we always go by the form. So if there are 4 laws written, we will only comment on the 4 laws. So now they have made it more sweeping to cover all statutory dues. And similarly, there was a reference earlier only to section 42. Now there is a reference to section 62 also when it comes to preferential allotment or private placement of shares. So I think that is my presentation for today. If I were to repeat at the end of it, that I feel the CARO 2020 has significantly enhanced the audit product. It has tried to bridge the expectation gap that we have always been saying. The expectation gap is around topics of what should be the auditor's attention to fraud, what is the auditor's attention to liquidity and going concern topics, and compliance with legislation. I think those are some of the important topics, and corporate governance, as I mentioned. So I think in my view, the CARO 2020 is a step in that direction, and I think it will raise the level of conversation that auditors will have with their companies in these areas or in these topics as well. Thank you.
Thank you, sir. We have a couple of questions which got posted on the query list. So if are those 4 questions. The first question is regarding whether the whistleblower fraud or the governance issues are not the item that are to be best disclosed in director's report. So, but then.
Yeah, I think it's difficult to answer a question like this as to say whether it should be best in director's report. The fact of the matter is that it is important for auditors to also look at this topic. There is an expectation from stakeholders that auditors should be cognizant of this. I think the question that has been asked here to the auditor is only whether you have considered the whistleblower complaints. They have not asked the auditor to disclose the whistleblower complaint. So I think it is basically, as I mentioned earlier, it is already a part of our audit procedures today to ask companies about that. But this positive assertion, makes it more important for auditors to certainly ask that question. And also my experience is showing over the last few years that very often you get very valuable information out of whistleblowers. So what you're doing by that positive assertion is putting both the company and the auditor on guard to say that you need to have dealt with them appropriately. And if I was looking at it from the other side, for people who may want to blow the whistle, is to say that this is giving a level of comfort to you that your complaint will be looked at, because it will be difficult for companies to ignore that now that there is a specific assertion.
Yeah. The second query is regarding in case of checking quarterly statements submitted with bank. Do you suggest that we get confirmation from the bank for statement submitted?
Yeah, I don't think that's I had not thought about that. But in my view, it may not be a bad idea. The only question will be the degree of compliances. I mean, we already know that getting bank confirmations at the year end is also not the easiest process, and you often have to now send team members to banks to collect that. So if you want to seek this level of assurance to see what has been furnished with the bank, you may need to do more. But if you ask me, it's not a bad idea to, on a test basis, do confirm what are those returns which are filed with the bank.
Correct. See, the next is basically regarding the group definition given in clause 16D. Now, this group definition is as per the RBI Act or the Companies Act?
I think that has to be as per RBI Act.
That
has to be as per RBI Act.
Sir, one more question. Are we required to report delay by way of days in repayment of statutory dues or just by mentioning as slightly irregular?
So I think slightly irregular is okay depending on the severity of the delay. If it has been a significant delay, then the number of days might be important to disclose. But otherwise, if it is not, if, for example, it's a few days, 1 or 2 days, few instances, then the current practice is continuous.
So, thank you very much, sir, for taking us through the entire.
Yeah, I have one question.
Yeah.
Regarding this income tax undisclosed income, now we have this Vivad Se Vishwas scheme going on by Government of India, by Income Tax Department rather. So in that case, suppose an SSC, an entity, he has entered into a dispute or he has filed an appeal for some addition made during the course of assessment, which is in the form of undisclosed income. Now he doesn't want to, go in dispute, and he files this under Vivad se Vishwas. And now this, as of the notification, it is open till 31st March. So he files that, and he decides to pay tax, and he paid tax. But according to the scheme, the final order will come, and then only it is whatever he has filed is accepted. So in that situation, what is the stand to be taken by the auditor?
Yeah. So again, if I go directionally by what this clause is intending to address, is cases where you have certain income which you should have recorded and you have not recorded that. I think in the nature of what you're describing, there are contingent liabilities which have been already disclosed as contingent liabilities and so on. Then this may not be such a area of concern. But that's why I give the example of a search or seizure scheme, where you say either some cash has been detected or some inventory has been underreported. If that is the nature of the things, then you probably need to record a journal entry to bring what was not in the books into the books of account. But if the Vivad se Vishwas scheme is often about dealing with topics which are of contingent liability nature, which may have been disclosed as contingencies.
No, there may be addition like, for example, unexplained cash credit, for example, which
Right.
is taken as income by the assessing officer, and it is disputed.
Right, in which case I think that will also probably fall in the same pattern, which it
Yeah.
should be recorded, I guess.
So only my issue was that till such time the order comes, it is not a confirmed
Exactly.
thing. So in
Yeah.
that situation, I think it will be little
Yeah.
difficult for
Yeah.
auditor to take a stand whether it should be accounted as income or not accounted as income.
I agree. I don't have a clear answer to that now, but I agree with you that this is a topic we will have to evaluate, as to how we reflect this.
Yeah.
Okay, so I would like to thank you, sir, for this lecture. Sir, as in his opening remarks, has rightly said and explained that as professionals, what are we supposed to do and not consider CARO 2020 as just another compliance checklist, but to step up to meet the expectations that is put up on us as professionals. Yes, we need to comply with this change, and we all need to adopt various procedures in order to conduct audit procedures to comply with this change in the requirement. Sir has rightly mentioned clause by clause what are the procedures that you can adopt and give a clarity on what is expected as an auditor by a role that you have to assume. I'm sure this would have helped all of us in clearing many of the doubts that have come up with this change, and we all step up for March closing. Thank you, sir. And I'm very glad to say that we've almost had viewers of about more than 200. So sir, it's a great achievement. Thank you, sir.
Thank you.
Thank you.
Thank you.
Thank you very much.
Not at all. I'm sorry we finished ahead of time. I couldn't take it to 8.
Yeah. And it's also from the audience, if there were more questions, we would have budgeted